Meet Daniel. He's 39 years old, working as a regional sales manager, earning $92,000 a year. He owns a home, drives a leased SUV, and takes his family on a nice vacation every summer. On paper, Daniel looks successful. But Daniel has $1,400 in his savings account, and if he lost his job tomorrow, he'd have less than 3 weeks of breathing room before real panic set in. This is the quiet crisis of the American middle class. Not poverty, not failure, just invisible fragility hidden behind a nice car and a good job title. And the strange part is, Daniel isn't reckless. He's not gambling his paycheck away. He's making decisions that feel completely reasonable. That's exactly what makes this dangerous. Here's what almost nobody notices. It's not one bad decision that keeps families broke. It's a series of small, sensible-feeling choices that quietly compound into financial stagnation. Let's talk about why this happens, and then let's walk through 7 traps, one by one, with the math behind each. First, the psychology. Behavioral economists call it lifestyle inflation. As income rises, spending rises with it, almost automatically. A 2015 study referenced frequently in personal finance research found that American spending tends to scale in near lockstep with their raises, leaving savings rates flat even as salaries grow. You don't feel richer, you just feel like you finally caught up. There's also loss aversion, a concept from psychologists Daniel Kahneman and Amos Tversky. Their research found that people feel the pain of losing money roughly twice as intensely as they feel the pleasure of gaining the same amount. This is why families avoid investing, even when inflation is quietly destroying their cash. Losing $500 in a market dip feels unbearable. Losing $500 a year to inflation feels invisible. But it's not. And then there's status signaling. Thomas Stanley, author of The Millionaire Next Door, spent decades studying actual millionaires. What he found surprised almost everyone. Most self-made millionaires don't look wealthy. They drive modest cars, live in modest homes, and avoid visible luxury. Meanwhile, many high-income earners who look wealthy are, financially, barely staying afloat. Now let's get into the traps. Trap number 1. Financing lifestyle instead of assets. Daniel leases his SUV for $650 a month. Over 5 years, that's $39,000 spent, and he owns nothing at the end. Compare that to buying a reliable used car for $18,000 and investing the difference. At a historical stock market average return of around 10% annually, that saved $31,000 could grow to nearly $50,000 in 5 years. The lease didn't just cost money. It cost the growth that money could have created. Economists call this opportunity cost, and it's the most underestimated force in personal finance. Trap number 2. Keeping cash instead of investing it long-term. It feels safe. It feels responsible. But the Bureau of Labor Statistics has tracked inflation averaging around 3% a year over the long run. That means cash sitting idle loses purchasing power every single year, quietly, without ever showing a negative number on your bank statement. Ray Dalio has said cash is often the worst long-term investment because it guarantees a slow erosion of value. Daniel's $1,400 in savings isn't stable, it's shrinking. Trap number 3. No emergency fund, but plenty of consumer debt. Roughly 60% of Americans, according to Federal Reserve Survey data, couldn't cover an unexpected $1,000 expense without borrowing. So when the car breaks down or the roof leaks, it goes on a credit card at 22% interest. Debt at that rate compounds against you the same way investing compounds for you, just in reverse. A $5,000 balance at 22%, paying only minimums, can take over a decade to pay off and cost thousands in interest alone. Trap number 4. Ignoring tax-advantaged accounts. Many employers offer a 401k match, essentially free money. Fidelity's retirement research has repeatedly shown that a significant percentage of employees don't contribute enough to capture their full employer match. That's not saving too little. That's declining a raise. If Daniel's company matches 4% and he's not contributing, he's walking away from roughly $3,680, untaxed, uninvested, gone. Trap number 5. Chasing single stocks or trends instead of diversifying. Peter Lynch, the legendary Fidelity fund manager, was famous for finding great individual companies. But even he warned that most people lack the time, temperament, or information edge to consistently pick winners. Jack Bogle, founder of Vanguard, built an entire philosophy around this. Instead of trying to find the needle in the haystack, buy the haystack. Index funds, which simply track the broad market, have outperformed the majority of actively managed funds over 15-year periods, according to research from S&P Dow Jones indices. Diversification isn't playing it safe, it's playing it smart. That's 5 mistakes. But here's where things get interesting, because understanding the traps means nothing without the alternatives.
Alternative number 1. Automate investing before you see the money. This is the principle behind dollar cost averaging, investing a fixed amount on a regular schedule regardless of what the market is doing. Studies from Vanguard have shown this approach reduces emotional decision-making and smooths out volatility over time. If Daniel automated just $400 a month into a low-cost index fund starting at 39, at a historical average return near 8 to 10%, he could be looking at roughly $300,000 to $400,000 by retirement age, without ever having to think about it again. Alternative number 2. Build a real emergency fund, 3 to 6 months of expenses, sitting in a high-yield savings account. This isn't about growth, it's about protection. Warren Buffett has said the first rule of investing is don't lose money, and the second rule is don't forget the first. An emergency fund is what keeps a temporary setback from becoming a permanent one. Alternative number 3. Capture every dollar of employer match before investing anywhere else. It's the single highest guaranteed return available to most working people, an instant 50 to 100% return depending on the match structure, something no stock market can promise. Alternative number 4. Understand margin of safety, a concept from Benjamin Graham, the father of value investing and mentor to Warren Buffett. It means never stretching your finances to the exact edge of what you can afford, whether it's a mortgage, a car payment, or a lifestyle upgrade. Always leave room for the unexpected. The families who struggle most in a downturn are rarely the lowest earners. They're the ones with the least margin. Alternative number 5. Think in decades, not months. Morgan Housel, in his writing on the psychology of money, makes a simple but powerful point. Wealth is what you don't see. It's the car not purchased, the house not maxed out, the lifestyle not inflated. Compounding rewards patience far more than it rewards intelligence. Now, let's see how this actually plays out, through 2 different versions of Daniel's future. Version 1. Daniel keeps leasing the SUE, carries a credit card balance, skips his 401k match, and keeps his savings in a low-interest checking account. After 5 years, he's roughly where he started, maybe slightly behind after accounting for inflation. After 10 years, mounting interest and lifestyle creep have left him with modest assets and growing anxiety about retirement. After 20 years, at 59, he's forced to consider working well past a comfortable retirement age, largely because his money never had time to compound. Version 2. Daniel switches to a reliable used car, builds a 3-month emergency fund, captures his full 401k match, and automates $400 a month into a diversified index fund. After 5 years, conservatively, his investments alone could be approaching $30,000, on top of a debt-free vehicle and real savings cushion. After 10 years, compounding accelerates, and his invested assets could realistically be nearing $80,000 to $100,000. After 20 years, with continued contributions and market averages holding historical norms, Daniel could be looking at a portfolio well past $300,000 alongside decades of financial breathing room his former path never allowed. Same salary, same starting point, completely different trajectory. The difference wasn't intelligence, it wasn't luck. It was a handful of decisions repeated consistently over time. Charlie Munger once said the first rule of compounding is to never interrupt it unnecessarily. Most middle-class financial struggle isn't a story of bad luck or low income. It's a story of interrupted compounding. One lease, one credit card balance, one skipped 401k contribution at a time. Daniel isn't a cautionary tale because he did something dramatic. He's a cautionary tale because he did almost everything that felt normal. And that might be the most important lesson in personal finance. The traps rarely look like traps. They look like ordinary life. Wealth doesn't usually arrive with a dramatic breakthrough. It arrives quietly, in the decisions nobody else notices, repeated long enough that the math eventually does the rest.